There we go. Good evening. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. This video continues our use of closed-end funds towards an investment strategy. And if you want the full methodology, the step-by-step guide, that's on my Facebook page. Just so if you go to Facebook and search "Navigate Your Finances," then you search my page, just put hashtag 12 steps. It'll show you a list of posts all about this 12-step program from getting you from where you are to where you want to be and beyond. So reminders, this is an unedited video, as you've already seen, but this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company. Sometimes I walk alone, and I'm okay with that. So why closed-end funds? Um, First, if you're completely new to closed-end funds, watch the previous videos. Really watch the intro videos, because that'll help explain a lot if you're new. We self-manage a closed-end fund only standard brokerage portfolio through Webull. And we recently added a Roth IRA through Webull as well that's going to be closed-end fund only. So why closed-end funds, or why CEFs? Discounts. Now, would you rather pay full price, or would you rather pay a discount? And in the current market, I mean, fear is selling again, so you can pretty much find everything on discount anyway. But if you're in a great market, would you rather pay full price over full price or a discount? Most people would rather pay a discount. You get a cheaper buy-in, you get great dividends, you get the overall fund appreciation, and you have inbuilt diversity. If you think of a mutual fund that actually pays you a lot more in dividend money, that's kind of like a closed-end fund. It's different entities, but it's similar. So where should you invest right now? Well, it doesn't kind of, it really comes down to your strategy. So I know our strategy. Do you know yours? Are you going to buy low and sell high? Are you going to dollar cost average, like buy at 9, buy at 10, buy at 11, buy at 9, right? And average your gains over time? Are you going to invest for the short term? Are you going to build something for the future? Are you hoping for an end goal? Like our goal is overall appreciation, yes, but really to retire and supplement a retirement through dividends. And are you willing to follow the herd? Because what the herd does doesn't really make sense. But if you're willing to follow the herd and still do your own thing, that really doesn't put you in the herd. All right. So if you're willing to walk a different path away from the herd, that puts you in better company. The herd right now is pushing fear for, gosh, the resurgence of Russia and Ukraine is pushing fear on Israel and Hamas, both of whom have been caught red-handed showing footage of other people's wars. Like Hamas drone strike, this damage. Wait, that actually came from a different source. It's kind of weird. The media is also, it's not kind of, it's really weird. The media is also both pushing AI and the advancements and the hope and the productivity and the reliance on AI and technology, as well as pushing the fear that stems from a society dominated by technology, because technology will take all of our jobs and render humans useless. So the blip in the market just happens to be where both of those things coincide, where the fear, or I guess the fear pushing from the media in regards to Israel and Hamas, and the fear pushing from the media in regards to AI taking over our world. And the economy is slowing. I still think we're headed towards a recession, but it's almost like they're distracting us for something else, and I don't quite know what that is yet. So, uh, strategy, our strategy, which I'll get to, right? We use that unless we have a great reason not to. Uh, which I'll also get to as well. We target monthly dividends unless we find an amazing deal on a quarterly player. We We're targeting bonds and loans if you can get them cheap. The only service I pay for, founded by Brett Owens, is still championing the bond bull. And I think that's great advice for our current Fed manipulated landscape, which it's always Fed manipulated, but it's for this Fed manipulated landscape. Bonds are a great idea. And then we're also looking at loans, yes, but then real estate, data management, technology infrastructure, and then energy infrastructure, which energy infrastructure could be oil, liquid natural gas, energy transfer, utilities. So is any of that still in discount territory? Yes and no, which we'll get to. So the special notes on that. If we find a fund that has convertible or preferreds, that's great. Convertibles meaning they can switch between stocks and bonds when certain conditions are met. That's great. And then preferred, meaning preferred shares get paid first before common shares. So if your fund has a lot of common shares and the dividend gets cut, the preferred shares have to pay that dividend first. Let's see. The Fed is like the media. The Fed's speaking out both sides of its mouth, or both ends of the eating system. You've got the Fed hinting that they're going to cut rates. You've also got the Fed printing money and wondering why inflation's going up. And then you've also got the Fed saying that rates might be higher for longer. Now, I don't know if they'll actually raise rates. If they raise rates, that's a very interesting system because they'll come out and say, we don't understand why inflation's increasing. And you kind of have to, I wish somebody would call out the lie. The quantitative tightening, right? Raising rates, pulling money out of the market, and secretly printing money is trying to mix quantitative tightening, raised rates, and quantitative easing, printing more money. So if they're printing more money in a stable rate environment, you would make a really good argument if you would just tell them to stop printing money. That would lower inflation. But the Fed doesn't want to admit that they're actually printing money. So they'll probably just raise rates. And I'm going to say this and be a lot different from the herd. Nobody likes higher rates, right? But what higher rates really do is freak people out. And it's not, it's bad in the sense of it impairs your ability to do more of what you have because your dollar is valued less. Inflation is not so much the loss of money, it's the devaluation of money. What you used to buy with $1 now costs you $1.50 to buy. It devalues the perceived value of your money. But if you can make money in a higher rate environment, then you can make money in any environment, which goes back to why is the Fed printing money in a higher rate environment? It's just kind of weird. So if the Fed cuts rates, everything will do well. The economy will surge a little bit, but I don't think it'll fix all of our problems. If they hold rates steady, I think we build confidence in the marketplace overall, but I still think recession coming. And if they raise rates, it's kind of more like a hat tip to recession coming. So as for our other targets, real estate remains the most dogged inside the market overall. And when the herd begins pushing bonds, which we're still on the forefront of the bond bull, but when the herd starts pushing bonds, it's almost like maybe we should consider going somewhere else. But with the recent media fear and the recent blip in the market, everything cheaper, it's kind of hard to pass up on bonds right now. And then in general, just real estate is just dog. So if we can find real estate cheap, that would be great. It's kind of whatever the media and those talk shows, circle junkies are pushing, like whatever the masses will follow, kind of like somebody waving a giant red ball at a dog, right? Whatever that dog will chase, we want to chase something else. So let's see if there are any bargains for the week, and then let's see who's got the best discounts, and figure out how to best play the long game for our portfolios. So let me share my screen. All right, so this is the closed-end fund master. It currently has 422 files or 422 funds, but we had a fund delist. Um, if I can find it, there we go. HTY delisted kind of randomly. I remember participating in this vote. I don't remember the outcome, but I guess this is the outcome. So once it finally say it's delisted, but at the same time it's still there. So once it drops off, it'll get deleted from the list. And that'll bring us to 421. Uh, there have been some changes to this file system, which if you've watched my videos before, you're familiar with these tabs at the bottom. This Roth system is new. Um, and we'll get to that. This portfolio or this collection of funds, it's not our portfolio. The gray remains the same. Color coding remains the same, except we're going to add medium blue, which would be probably that color blue, cornflower blue. We're going to add medium blue to this for the funds we own in the Roth. So gray is not our concern, doesn't meet the standard. Purple is recommended by somebody I trust. Green is things we track. Like we used to own this fund, but then we sold it so we could fund our Roth. Light blue we still own. And then the targets are based on the discounts. So if it's got a triple asterisk, it just means the current discount is greater than double the historical discount of that single fund. And it's also greater than the 5-year discount for that single fund. 2 asterisks would be a dollar cost average based on what we already own. And then 1 is just tracking for any number of reasons. So how to sort the data? We sort by discount. And then we sort by target. And the latest blip certainly impacted how many targets we have. Come back to the end, plunk these on here. All of this gets boosted over. That's our existing investment. And then we can put equals that minus sum of, well, we'll hold off. It'll make more sense. Let's see, can I increase this video size or the screen size? All right, so how to rank these funds. Our goal is monthly. So everything not monthly comes off. Our goal is 9% or greater, but there's an exception. HFRO is the exception, remains the exception. We come back, it is the greatest discounted closed-end fund. And I've seen, both sides of the scale reports, but I still think the fears are overblown. At 50% off, I mean, so instead of, if break even is $1 and you're getting 50% off, that means you're paying 50 cents for every dollar invested. That's insane. Versus the flip side, instead of paying $1 for something, you're now paying $1.92 for something, right? I don't want to pay premium. I want to pay discount. And HFRO has been up and down. They've cut their dividend in half. They switched from primarily bonds to primarily real estate and loans, which is very different from what's displayed. I'll get to this company in a sec. It's very different from what is still displayed online. mean, their top holdings are very similar of what I can find on the semi-annual report I'm going to show you. But this is as of 12/31. If I go to Morningstar, it's the same thing. It still shows December. But this is from June of last year. And you'll see they've transitioned their portfolio. And if you come down here, just general shares, just common stock of real estate. That's a very different portfolio than what's displayed online. And it's the same thing. There we go. It's the same thing on the more recent semi-annual report I've been given from them. So it's just kind of interesting how their report says something different than what's posted online. But they've transitioned from primarily bonds to primarily real estate and loans, which you can argue bonds and loans are similar, but not the same. Real estate and loans are similar, but not the same. It's just interesting. But I think we would be foolish to ignore it. All right, back on track. So we want 9% and above. Okay, RMM isn't 9%, but it's a municipal fund, so it's tax-free. So it's like 9%, even though it doesn't look like 9%. And then these come off. Me personally, I don't like consumer funds. You can argue that real estate and loans, like everything's consumer to a degree based on cyclicality. I don't know if that's a word. But like if you look at the chips aisle of the pseudo food aisle, chips are cyclical in that they're popular when people are grilling. They're popular when kids are home a lot, but when kids are at school, they kind of die off. And in a recession, people cut the fluff. So they might keep ketchup and they might keep pickles, but they're not going to keep chips. So the consumer market as a whole is too volatile for me. But grills are a consumer product, and cars are a consumer product, and technology is a consumer product because there's a lot of tech purchase in the advance of every school year. Housing is a consumer product because it's cyclical in nature. But I think we can separate different types of consumer products from the general consumerism or general consumer market as a whole. So what does that leave us with? Oh, we got one hiding. We don't want that one, not monthly. So portfolio in a can, a lot of tech and tech use, but not on my list, mainly because of price. I mean, it's a little high. With a Roth, now, and normally I'm doing videos on what we would buy if we were buying tomorrow, but it's limited to our individual brokerage account. This video is what we would buy if we were buying tomorrow as we make our first purchases inside the Roth. So we're going to be buying more than just one or two things. And yes, I get it. We could dollar cost average over time. We could do it a lot of different ways, but with the market dipping, we're just going to buy. So in a Roth, tax-free income doesn't necessarily help because it's a tax-free account. Now in our brokerage account, like that would be an interesting consideration. But we're looking at a Roth. PDT, interesting portfolio, and it's predominantly utilities, but oil right now is high. Like oil and utilities and energy transfer is predominantly higher than it's been in a while. It's also finally come back into favor, I guess. People are like, hey, that's doing well, I'll buy it. So I'd prefer to buy when things are lower, not when things are higher. So, and yes, we get it at a discount, and it's a significant discount compared to its historical data. So you're getting it at a discount, but at the same time, it's also priced at higher than what it's been in a while. I'd rather buy it when it's lower than it's been in a while. Saba is the flip side to BRW. BRW is corporate bonds and Saba's government bonds. So uh, you get higher risk and more consistency, but and Saba almost made the picks made the pick list for the week, but I forget the guy that bought Saba and BRW and turned them around. But you got a billionaire investor who likes buying companies and turning them around and improving management and improving payouts. And Boaz something, I forget. Uh, so BRW has done consistently better since new management. Consistent dividend. I like the consistent dividend and a great consistent dividend. This one is not as consistent. Uh, you can argue for buying it when the dividend's lower in hopes that it'll go higher. It's government bonds, they're fairly reliable in paybacks. But in the midst of everything else, I want consistency. And uh, yeah, I can't. Like it's tempting, but not right now. And that leaves me with this 6 funds. So taxable senior, which you can pause the video and read the snippets that show up. You get corporate loans, bonds, assets around, gosh, real estate, energy infrastructure, bonds. It's also got data management. I don't know why that got deleted off. Corporate bonds, but I like the idea of an all-American corporate bond system. Two guys I enjoy reading. And it's a tech fund in an AI play, but it's not outright. Let's see. There we go. You can pause the video and read this. It's not an outright Taiwan Semiconductor. It's all the companies that rely on tech and would do well in a 5G tech world. And then you have this, which is kind of the outlier. Dividend cut, but it's been consistent since they cut it. And it's that looming hopeful Fed cut. If the Fed cuts rates, all of these will do well. But it's not just that. If the Fed cuts rates, all of these will do well. If the Fed raises rates, all of these will do well. The goal is to build a portfolio that does well in any environment. Because I don't want to have to worry about selling funds or that, right? I want to add to what we buy, but I don't want a lot of volatility inside the account. OXLC, let me go back. Oxford Lane has been on my hit list for a while because it rarely goes discount, and it's built exceedingly well and it pays amazing. It's like, oh my gosh, look how big oh wait, it's maybe not that big of a difference, but it looks like it because of how wide that gap is. But of where it was pre-pandemic, it hasn't gotten there yet. So there's still room for this to grow. It's primarily bonds. Pricing, you can see that it's pretty much premium. And it really doesn't hit discount in a while. Like it really doesn't hit discount ever. So to scoop that significant of an overall distribution is kind of crazy. And what doesn't make sense is this. When the share price is under the value of the company, it's flipped. When the share price is undervalued, so that's the actual value of the company, you can buy it on discount for this, which we go back to our page, right, is not that much off. But that's where the discount to net asset value, or the discount overall, discount to net asset value, discount to NAV is, yes, there's a huge difference between 50% off and 0.4% off, but they're not related to each other in the sense that, yes, they're both discounts, but that's it. The 50% off is related to that one company. The 0.4% off is related to that one company. And it's significant because it's that one company, right? Historical data is almost like 18%, or well, historically there is no discount. It's all premium. The 5 years, it's close to 18% premium, meaning instead of you paying $1 break even, you're paying $1.18 every time you buy it. Just so happens right now, it's a little less. So instead of it being $1, it's 99.6, or it's instead of it being $1, it's 0.996 for every share you buy. But we're not going to buy premium, right? We only buy discount. So even though it's not that huge of a discount, it's significant and related to the data for that one fund. So then it just becomes a game of how much to buy of each. And since I already screened my own video of what I wanted to do, I kind of already know the data and how it works out. But on your page, if you ever build a spreadsheet, oops, so it's equals the number you're starting at minus the sum of these blocks has your remaining balance. So as you adjust these numbers, these cells adjust and that cell adjusts. We already own NBXG in the brokerage fund. We sold FCO in the brokerage fund, so we could buy it here. Same thing with BRW. We sold BRW. We sold HGLB. We sold FCO. And I would get less to start off. I would get less of these just because they are, well, not so much this. It's just how it worked out, to be honest. I don't think I could. Yeah, it's negative. You only have so much money. But with it's that with the conflicting reports, despite my belief that the reporting fear is overblown, in relation, like just of the values for what else is on the list and how it worked out. Like, let's see, like, could we do this? Yes, we could do that. But right now, yes, that dividend pays. Yeah, there's a little shakiness on this overall company. It just works better that way. Long term, the goal would be to increase the amounts of all of them and increase that one. So the near miss, I guess you could say, Saba almost made the list, and it would have replaced NBXG. But Saba's dividend history is a little like it's been consistent the last 4 months, but prior to that, it's been very inconsistent. Maybe that's about when they were taken over. It is government bonds, and they are more consistent in paybacks. But honestly, as bond heavy as we are already, I'm all for target. I'm not into diversity for the sake of diversity. I'm into targeted funds. And that being said, to have loans and bonds and other stuff, kind of portfolio in a can, bonds. Saba would be government bonds. HFRO would be real estate and loans. It all, yes, goes together. NBXG gives that little bit of twist in regards to technology that's still needed. It's higher than what we initially bought it at in the brokerage fund, but I still think it'll ramp higher still. And yeah, All I can say is it makes me feel better doing it this way than putting Saba on the list. That's the only, it's that gut feeling of uh, one tech fund instead of all bond and loans. So take it for what it is. But normally it's if we're buying tomorrow, these two things would make the top of the list. But the goal is to buy tomorrow and add the initial batch of funds to our Roth. We can just set it and let it go. And what it ends up being, oh, come on now. You get to see my fun mistakes live. So what it ends up being is this. And I want to say when I did the math with Saba, if I put Saba here, yeah, we could have bought a lot more of it because it's $3 a share. The dividend actually goes down to like 805. So it's not a huge difference, but it is a difference. It's kind of interesting. Maybe it's 803. We can easily look at this. It's the advantage of this spreadsheet. So if we make this, make it we'll make it 200. 742. So this plus this, right, is more than 742. So we can make it 200. We'll see if I have my memory right or not. So you get 755.01. See my math from earlier. 200 would be 69.6. Look at that. It's more. It's more than that because I did my math on 150 shares and not 200. So with Saba, it is $9 more. Could we add it in the future? Yes. Um, could we add it now? Maybe. Kind of depends on how all of these funds open on Monday morning. Like if OXLC opens at $5, well, it's no longer on it's no longer on discount, and we're not going to pay premium. And I get that it wouldn't be that premium. Like it's pretty much break even, but we're not going to pay premium. So could we still buy Saba? We could. So we put it down here. But pending how things open Monday when we buy, we'll see how it goes. And then I'll end up putting the results here. And yeah, probably review that on next week's video. So that's all I got. Otherwise, I will keep rambling. Uh, if you like the content, consider subscribing to my channel. Hit the like button. It really does help push these videos out to other people. And then head over to Facebook and check out my group there called Navigate Your Finances. Uh, whatever you have, like whatever your goals are, whatever your overall dreams are, you're in charge of the ship that's getting you from where you are to where you want to be. So captain the ship. And if you have no idea where you're going, that would be an issue. If you have no idea why you're on a journey, that would also be an issue. And then you would check out my page at Facebook and then figure those things out. Or comment here and let's chat about them. And regardless of where you're going and why, whatever that why is for you is not going to happen unless you make it happen. So whether you're on the financial freedom journey or not, if you're on I'm going to figure out the stock market journey, or if you're on I'm going to better invest my money journey, whatever it is that you're doing and wherever it is that you're going isn't going to happen if you do nothing. So I use nautical metaphors a ton. So you've got your ship, and I prefer the giant pirate ship. And there's a lot of people on that boat. Any one of them could lead, but you're the captain. So if you do nothing, the ship will float aimlessly. Maybe you'll have mutiny and somebody else will take your ship and kill you. But if you're still in charge, you're going to have a boat full of people not going anywhere except for wherever the wind and the waves push you. Or you can lead. You can be like, we're going to go over there. We're going to go to that. We're going to go to that treasure island and get the treasure, and then exist after that. Because on the pirate map, it's you've got the boat, then you see those cool animated graphics, pull the boat over that water map, and you hit Treasure Island. You find the treasure, and then there's life after that. But none of that happens unless you do something about it. Whatever it is, whatever your why is, whatever your goals are, whatever your dreams are, you have to make them happen. Otherwise, they'll never happen. So it just comes down to, are you willing to take on that challenge? Are you willing to do the stuff that you want to do? And are you willing to do the work so you can live the life you want to live? And I'm not saying it's all roses. I'm not saying it's perfect weather. I'm not saying it's smooth sailing, but I am saying that it's worth it. Because if you can get to that island and live beyond, you will have done something monumental for you, but also monumental for whoever comes after you. But it's reaching our dreams, making those happen, and then continuing on, because the story doesn't end once you hit the treasure. That's just the beginning, right? You have this journey, the treasure, and then the beginning to the next part of your life. So whatever your dreams are, whatever your why, like, why does all this matter? Whatever your why is, make it happen. And you can if you will captain your boat. So that's all I got. I hope y'all have a great week. Wish you well, and I will see y'all on another video. Bye bye.